Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. It is Sunday, April 28th, 2024, and I believe it's just about 10 a.m. And to probably everyone's approval, I'm going to try to really get this done quickly to try to stick with a new format that just keeps bringing things in a little bit more in terms of time. Here's our trusty disclaimer, and here's our trusty intellectual property rights notice. Uh, yeah, I'm a little under caffeinated, so I have to power through this. Maybe have another cup of coffee here, but we will get it done. Let's see. Let's get into just this week's notes. I'll leave those up, and then I'm going to flash last week's, and then we will come back to these. So these are last week's if you wanted to see what we had there. And then we will go back, but that's just a quick reminder if anybody wanted to pause and screen cap that. Anyway, I'm going to talk about this stuff here, and then we're just going to go to the charts and I guess wrap up. So I can save everyone a lot of time right now saying that it's almost impossible to forecast anything, right? When you have such a deluge of EPS reports coming out, I think especially midweek and beyond, it gets really intense. There's a great number of companies reporting. There's big dog companies reporting this week, and of course we have the FOMC to add to it. So if you know how all those earnings are going to uh, play out and those what those reactions will be, and you already know what the Fed will do and say, and the reaction to that, please tell me where I can watch your video so I know what to expect and what to do, because I certainly do not know. And that's why, right, when you've got that many wild cards, I really don't like to make predictions to begin with, because I think the more you make predictions, the more you bring your ego into the mix. The more you bring your ego into the mix, I believe very strongly that you're doing yourself a great disservice in terms of short-term trading, probably even other durations as well, but certainly in the short term, having really strong opinions and not being willing to be flexible and shift is not my idea of what will work in the modern markets at the very least. So anyway, that's where I'm at. I think the gang is going to do the gang's thing this week. We're just going to see, no matter what we dial up on the charts, and I think we can dial up a few interesting things, but it really almost doesn't matter, because that can, right, when something's so powerful that can trump the charts, uh, you can chart all you want, but in the end, you may always look back and say, well, everything was working out great, but then this news came out and this is what happened. And that's the problem, right? That's very hard to predict. Just look at this week if you want to see how hard it is to really predict things. From what I could tell, Tesla, the news was bad, right? Overall, right? That's no surprise. They jammed that higher. Meta, Ryan, my partner, thought that stuff looked pretty solid, and they smashed it. I'm not a I'm not a fundamental analyst. I don't even have the time to even think about that stuff. And even if I did, I wouldn't have strong opinions, because I'll never be able to have the resources and time to compete with the street on that. So I really don't get involved in it unless I can connect the dots, so to speak. And that's just my quick take on that, for anyone that's newer. But yeah, everyone that's been with us for years knows that I am not a fan of EPS season, nor am I a fan of Fed weeks. I know a lot of people that like to speculate are, but I feel as though the probabilities that we are basing our ideas upon, and what's most likely to happen based on charting for so long and being able to say, like, under these conditions, this is what's most likely to happen, and that plays out fairly well, I think, most of the time. But you have to still be selective, right? That's I think part of trading is being selective, knowing when it's a good time to push the pedal to the metal, so to speak, and sometimes when it's better just to throttle back and not really go for the gusto, because you're in the teeth of EPS shenanigans, which clearly bloomed this week. So the gang is always going, in my opinion, the gang is always going to take high profile things that virtually everyone knows about and use those to their advantage in both directions, right? So if the gang tends to profit, right, themselves from price change, just like directional traders do, just like momentum traders do, that we tend to be in a lot of our services. And they're operating to the beat of their own drum because they're the gang and we're not. So when they let things happen, they release things or they can't prevent it. It's a whole different discussion. But we said coming into the week we thought there was enough technical damage for a legitimate relief rally to possibly unfold, and they really didn't waste any time. They got that squeeze, that rally, going. It did have a little bit of, I think, a little bit of a struggle here and there at times. It wasn't as if it was just straight up, right? But that was again dependent on what the news was. I think they had news that was really affecting prices from day to day, and that's just part of it. So the early part of the week, we just saw that continuation, and then we saw the big earnings reaction down, and then we saw the move back up, and then the jam job back up further. So overall, it was probably a nice little positive week, and a lot of sectors did start to bounce back. Speaking of sectors, there's another note here. If you're wondering what's going to happen, remember the Street of Schemes lowered the bar recently on 7 of 11 of the S&P sectors. So that sets them up for the easy beat, which is what that keeps the music playing, right? It keeps everyone drinking and dancing. The lights stay on. And that's why the beats ratio is something to me that's just a joke when they put that on there, because it's almost like quarter in, quarter out. It's almost just about the same regardless, where 70-75% are beats. If you were putting out, as I note all the time, if you were putting out your real number, then it should hover somewhere closer to 50, right? It should be like, well, I really thought this was going to happen, but it missed by a little. But we know that they make it easier for these companies to beat, and these companies are masters in corporate accounting, and a lot of things can be massaged and hidden. So, right, I would be surprised if there was a really dismal earnings season here. Again, I'm just saying that just perception wise, I have no real data to back that up. I just feel as though if that were the case, we wouldn't have bounced back as strongly as we did, or we will roll over again hard soon, which could happen. But I just don't have that sense that this is the quarter where everything's a big problem. I think maybe Q2 might not be that wonderful, but we'll see. We'll see what happens. Anyway, the gang did their thing. We talked about that. We talked about how we've been saying for a long time that, right, that the rates lower sooner campaign, they ran for a year, second year in a row. That hasn't played out, and we don't like going against the market's expectations. But the market, again, I think was way ahead of itself, and I do think some of the under the surface stuff that we try to keep an eye on, which has been saying that things were softening here and there, and it's starting. This debt servicing was starting to have an effect. That did start to evidence itself this week, and I think you could see that with some of the stagflation headlines that started coming out this week in different places. So that's that. The issues are still there. I just noted a couple: auto market, housing market, debt servicing level, debt levels. It's all the statistical chicanery that's going on, right? It's a lot of it's been exposed, but as usual, you have to look for it. It's a lot easier these days to get your hands on things like that. It was very difficult for me to find. I think what I would call like the true story 25 to 30 years ago. But now, there's a lot of sources out there that you can tap to get a sense. These are all secondary reports. I don't subscribe to anything. I just kind of follow folks on Twitter that I think tend to try to put that stuff out, and I'm relying on their sources, of course. But I do think that the auto market's in trouble. I've seen some real problems there, despite what GM stock is doing. And I've seen where things are starting to really become a problem price-wise in housing. It's not as though prices are declining. It's just that people are not nearly as interested as you may expect at these levels with their incomes, the way that they've remained, and given the interest rates. So it's a rough combo. However, right, we can sit here and list that all day. We can also talk about how, this, that, or the other thing could happen. But the reality is that Yellen supposedly, apparently, according to some reports we saw, is about to lay her hands on another 1 trillion plus at the Treasury. And as we noted on Cocktail Hour, this has a way of working its way into the equity markets somehow. I don't have the chain that I could show you to say this is exactly how it works, but it's been we've seen a lot of let's say graphics published, and you can pretty much see that when things are with money is easy to be had, and financial conditions are just easy relative to where they had been, and that's still the case even this year, despite what you might guess, right? Given what the Fed's been doing, leaving rates where they are higher for longer, as opposed to lower sooner. But that's the financial conditions have been easy, and they remain easy. So you've got the Treasury really going overboard compared to times past. That started, that's a recent thing to this extent. In other words, it's probably always been there to a degree, but it certainly has been ramped up in modern times. And we also know that the statisticians have done some tremendous work to mask this, that, and the other thing. That's been called out all over Twitter, formerly Twitter. However, right, when you have that much money coming online, so to speak, and you've got the fourth year of the presidential cycle, and you've got the fact that if we adjust for inflation, stock prices would be higher, right? If they were to match their all-time highs, there's still room there. In other words, you can't rule out that there could be more upside, right? So if you're starting to get really bearish, I understand that. It's just that, especially right with yields kind of not giving much back and kind of consolidating gains to this point. I get all that. I know there's a yen issue out there. I know there was a bank failure in Philly that got reported, which we've been saying, right? We don't think the regional banking situation is as good as they would have us believe. Nothing's new there. I'm just saying, with all this taken into consideration, you have these other factors on the other side that mainly, right, there's a lot of money and there's a lot of people that think that this market's not expensive. So, and you have the inflation factor. So we have to respect both sides. I think I'd be surprised if they didn't do more. I don't have any over the weekend news that I know we're going to open lower. I have no idea, of course, what yields will be doing on Monday morning, but assuming neutrality on those two things, I think they're going to try to work this thing higher, mainly because Nvidia and SMH, which I actually had paper hit on Friday, that was ostensibly bullish, excuse me, and that looks really potentially poppy to me. It's got to obviously get through critical resistance, which will show. But if it does, right, and they've got the earnings season to work with, they've got the bears, the shorts on the ropes. I think they're going to start. Bubble Vision will come back again with, oh, Nvidia and the semis are saving the world again, because that's what they ran last time around. As ridiculous as that is, but let's face it, we're in ridiculous times. So I guess that's to be expected. Risk on came back somewhat. So not every sector levitated back higher or squeezed higher, but we definitely had many that did. And probably some of the really key ones that were leaders, like the XLK, like XLE, which recently was, started working months ago and just took a breather. Now it's trying again. XLF came back. We had some trades in there. XLC, that came back, after it looked rough on the Meta situation, but they brought that one back with gusto on Friday. So that's what we had. So yeah, there was definitely more kind of risk on again. And I think we shouldn't be surprised by that. I think we said it last week, where, again, where they pulled back to was not insignificant. There were a lot of reasons why we thought support would be roughly where it was. And we also said that, look, the market was actually down more from the high than it was up on the year near the recent lows. So they tried to rectify that a little bit for sure. What was interesting was we started seeing paper come in, and we normally put out our newsletters for UOA and even the momentum, pure momentum, we usually put those out later in the afternoon, actually sometimes even after the market closed. But we saw some really aggressive call buying in SPY. So we rushed those out early, and that turned out to be a good thing to do for subscribers. I hope a lot of folks did well, because I think they pushed things that we pushed something when the spies were near 490, I want to say like 7 or something. We pushed 496 maybe very early in the week. It might have been Monday. I can't remember, but it was very early in the week. We pushed it out. No, it was Monday. We pushed it out on Monday, and then they did come in after things. They moved things from about 496 to ultimately like 506 or 507. So that might have been good there. In terms of when they came back for puts, interestingly enough, there was a put trade that hit the tape, and then we saw a drop. So we saw a real serious drop after that. So whoever these players are, they've been pretty good in these index ETFs, major index ETFs. But what we're going to talk about technically right now is just tapping the underside of former support, hitting SMAs that are down sloping, and then we should be watching out for levels of participation, right? If this is really narrow, then I have a more of a problem with it. In other words, if it's just them doing what they normally do in the big weights, remember we talk about this all the time, how they have to move these big player stocks up, the Amazons, the Apples of the world, all that kind of thing. That is an issue, because that alone, right, is not something that you really want to see, where you're so dependent on just a few stocks. And that doesn't really augur good things for the overall market if everything else can't rally, and it's only the gang being the gang, moving up the biggest of the big to keep the indices levitated. So I prefer to see more buying, and I think there was some. I'll say that I think there was some, but I'm not going to go into anything else at this point, because it's just not worth it. Everybody wants to get this stuff over and done with. There's a lot of things out there that I would like to show that I'm just kind of restricting myself from showing. So let me just regroup here, and I'll pause briefly, and we will get this out of our way and then just go right to the chart. So let me just pull up my basic chart, and I'm just going to keep it simple and just do the main four, and anything else that springs to mind, and with the addition of the semis, like I said, and NVIDIA. But I happen to be on the diamond, so I'm going to stay here, and you can all see what I mean, I think, pretty clearly with the downsloping. I'll make sure this has got the right screen, with the downsloping SMAs now. And so if it shreds through this, if they shred through these things, then excuse me, like they're nothing, that's great. But the 20 was respected there at the highs last week. But we do have to note now that they do have a higher low put in as well, right? Yet it did get kind of caught up on the close near the red 15 and the dashed white 100 SMA. So that, to me, right, that's telling me, right, that if I back in my old days where I was generally long gamma a lot, I would just be scalping stock until I start to see something else emerge, right? If I'm really kind of between this low, and I have to really take out these highs, I'm not really in a trending phase right now, right? So I'm more in my mind at least, we're more in a consolidation. Could all change the first hour on Monday, who knows? But right, I would start feeling better if it gets back above the 20 there in light blue, and then if it holds and it can get back to the 50. And I wouldn't be surprised if they're able to get back to the 50 here. Like I said, I think there could be that sort of optimistic take in the early part of the week where they extend things, excuse me, thinking that they're going to be able to use earnings to, maybe jam higher and then sell into. And then they won't, if they do that in front of the Fed, that way, right, if the Fed is an issue, somehow the Fed becomes an issue with whatever's said. That hasn't really been the case lately, but you never know. Then, right, they will have offloaded a lot of stock using the EPS that are going to be released prior to Powell's performance. So I've got a couple flat lines that I put up there just to kind of ballpark it, I think about 388.50, right? That's another line. So this should be a stout area if in terms of resistance. If the bears are still there and just waiting, biding time, waiting to start selling at another level, it shouldn't really be a cakewalk for the diamonds to get through this level, 388.50. If they do, note that they'll be above all SMAs again, and also note that there's another level, I think just a hair under 392, but just call it 392. I think that's your next level up there. So, and at that point, right, you're a stone's throw from the all-time highs at that point. So, I wouldn't really rule that out. And the reason I'm saying that is, right, look at this trend. You've had this corrective activity, right? The long-term trends are still upsloping overall. So I tend to give the trend itself the benefit of the doubt rather than fight it, because trends persist for a lot longer than most of us expect them to, quite simply. So that's just been my experience as well. That's exactly what happens. So all these problems get identified by bears that are on the lookout, and usually they're well in advance, and the market doesn't really, I think, recognize the issues the bears decide to hang their hat on way too early, usually until the market wants to, which is usually much later, and usually when it's forced to, because they've played everything out the best they can, and they're kind of forced to admit, well, there really isn't any reason to buy stocks or even create a squeeze at this point. But that's the levels I'd look at. Clearly, right, I'll say this on every one of them, but this is it, right? In the diamonds, if they start to lose last week's low, then you are then back very quickly towards retest area. So I would go on that, and if they get it through here, right, again, I would let it probably try to run up to the 388.50 level if they get through last week's highs. It's not that big, right? It's only 385. So, but I think there's another 1% for it to run there, just to say. And so you've got to really go. This is what I do all the time, incrementally. You've got to go incrementally here. You've got to say, okay, if it gets above there, can it hold? That puts it above the 20 as well. Only the 50 will remain. Will they get it above the 50 and be able to hold? Will they poke it through? Will it get sent back down? If. So there's so many scenarios that I could draw out right now, but in the interest of time, I'm not going to. I'm just going to throw them out there, audibly. But there's a lot of things that could happen, and you just don't know if this little attempt here is also just this little kind of pop back up. If this doesn't work, then this could look like one major leg lower, one reaction to that leg, right, where it tries to rally, fails, and then rolls over, and there could be another entire leg to follow. But I wouldn't worry about that at the moment unless, well, news develops, but certainly technically speaking, until those lows get taken out. So that's where I would be on that. I'm going to jump over to the SPY, and then we'll start moving a little more quickly because it's very similar, right? It's the same stuff. I'm not going to mention the lows, this and that, but this is very close to, I don't know why it resized like that, but this is very close, right, to being above the 50 in gold and the 20 in blue. And so that's pretty impressive, right, already, who'd be able to do that. Just about, right, got to the 100. You have to wait and see if it can get above here, it can hold above here. To me, there could be a couple other kind of minor levels, but I think a major level is going to be about 517.50, right? And if you get through there, that's a stone's throw. You have to wait and see what they're able to muster here. And I'm just saying, my guess is that the early part of the week seems more conducive because to be able to help them rally, because I think the earnings really pick up midweek and Thursday and beyond. And the Fed, of course, is there on Wednesday afternoon. So if they're going to put their little, put a little rally together, it seems easier to do it sooner than later. But I think you're approaching things very similarly, right? If this low is under pressure from that's very close to the lowest low from the prior week. So if you start to see this low on Thursday become an issue, you have to start getting concerned again. If not, and they get this above here, right? I would try to let it work back up because I'm sure a lot of people are saying, how does the market have any business being anywhere near where it is? Because look at all these things that haven't borne out. Look where GDP is really tracking for Q2. The Fed appears to be in fantasy land again on Q2 GDP. Usually the street is overly optimistic too, but the Fed's at like 3 point something percent for Q2. Wall Street consensus is for less than 2 right now in terms of the GDP growth for Q2. So as of right now, it's really not looking very good. But again, like I said, the last couple of weeks, the worse things get, the better the argument becomes to get rates down sooner, right? So it is what it is. This is why, like, between the earnings, the Fed, and the charts looking so similarly, there's really nothing for me to add here other than I must have forgot to turn these alarms off. Sorry about that. Other than, right, you're just getting near the 20 in blue. You've got the gold SMA in form of the 50 is right there. I've got a couple other lines up here. So I think this 435 area is going to come in and kind of work in conjunction with the 50 and 20. So this might not be so easy for the Qs to push through unless they gap, right? Then it's a lot easier. But if it sort of attempts to do it midday without the aid of any news, it's maybe not going to be an easy way to go. But I do think, I would say that early on, that's when to me it makes sense. And I do think if they push, you're going to get up into this 441-ish, which is where our line starts coming in. So 440, 441, 442, that would be pretty significant resistance, I think, as well. So that's what you have to do. You have to look at incrementally above the 20. Okay, it took the 20, it's holding. Can it get above the 50 and hold? Yes, it's doing that. And then you're looking at these levels like 441, 442, somewhere in that ballpark. If it gets through there, I don't even know what to say. I mean, I've got another level up here right near 445, 446, but there's definitely some tops and closes that get put in there. But at that point, right, you're really through. Getting through this line to me and holding is a really good sign if they're able to do it. You all know the drill at this point. Below, right, basically below Thursday's low, you've got to start worrying again. Because remember, these are now downsloping. Usually it's difficult, right? It shouldn't be so easy to get through all these things because they're very supportive on the way up. They can be very restrictive in terms of upside when they're rolling over. It shouldn't be this easy little maneuver to get through them. But remember, the news this week and those reactions and the gaps that are possible make that process easier because it's a lot easier to move the futures up when not everybody's paying attention essentially right overnight or in the morning. And that's done with regularity. And if you go look for the video, you'll see old Jim Cramer admitting to doing that exact thing. Anyway, IWM, and then we'll get to NVIDIA, SMH, and we'll wrap it up. But it's a similar thing, right? I'm not really sweating anything until this Thursday low is under pressure. You can see that this thing got bottled up right near the 100 and the 15 in red. The 20 is right there in blue, and you've got your 50 up here. And I think that's a big deal for IWM because to really get somewhere, it's going to have to take that one out. I think as long as it's tamped below there, I'm not that impressed by it. If it gets above there, I'll feel a lot better. It's about it, right? And if it can hold back up there again, I would keep your eye on yields, especially though in relation to this one, because there's a pretty good inverse correlation there. It's not moment by moment. It's not like you're arbitraging something, but overall, when yields are moving higher, tends to pressure this, and when real yields are sliding, the gang tends to try to come in and use this vehicle. It's a great trader, though. So it is what it is that way. Here's the thing. SMH is one thing, and I've got this marked up for us. SMH is one thing, and that does look very interesting, right? You have to, I think if I can enlarge it, you can see that. So it's already back to the 50% retracement from the whole move lower. And you can see that if it just does a little more work, it's going to take out the resistance line. If it takes that out and holds above there, that tells me that the corrective activity may have completely run its course, right? So I don't consider these lines small things. I know a lot of people have problems with lines that are drawn on the price structure, but they've always served me well. They continue to serve me well. So I'm going to continue to use them. I'm not changing my mind just because they're not popular anymore or whatever. I still think they help out. But the next level, you're near that 223.59 that I've got labeled there. That level is just really close to our downsloping resistance line. So basically, if you can get above 224 and hold, I'm feeling better about SMH. And I do think it's possible, like I said earlier in the week, it makes the most sense to me, but who knows? And then you've got this low that's just below 206 that would get me worried all over again, like, uh-oh, like, are we going into a retest that could or could not fail? So that and see, I should say, and see failure. But what's interesting is that the stock of the moment, right, the stock of this bullish market that we've been in now for half of a year plus, this is breaking out. There's nothing really that to me is already on its way. And so this probably had a lot to do with what some of those big dog companies had to say, but in terms of what they're doing with AI. But that's just me speculating because I really didn't have time to read those research reports or anything. But I think you're looking at the next level up here to me is about 906. 906 is where I'd ballpark things at if it keeps going. It's certainly right at another flat line in my book, right where it is right now. But I think right if they open things up, you may as well use the figure 900. Then you've got about 906. Again, you get through 906, you may as well start thinking about what kind of upside there could be. So the way that this really powered is very strong, right? It's a really strong 2-day performance there. Got through every SMA and got through our resistance line. So that's impressive. And it also means that, right, the leader of the leaders, right, the semis being the leaders, but the leader stock within them and the stock of the moment, the face of this market, is acting really well again. And so if you just use, those are the levels I would use, like I said, 900, 906. I think those are your big levels that are coming in. And this thing, right, if you get some good feedback from some of these other very large companies and they talk about AI, remember, that could really help the cause. When stocks are really popular, they tend to really rally strongly into earnings. So this is a ways away, right? We're talking about 3.5 weeks, roughly speaking. But you're close enough to where that pre-earnings run could start to get legs. And if it does, right, again, to take the silly line from Bubble Vision, CNB Bubble Vision, this could be the savior yet again, because that's just, unfortunately, right, that's how markets work. And I think not every company deserves a rally because NVIDIA and big players are really going heavy into AI, but that's the way that they play the game, right? They just start buying because this is working and that's been working. It is what it is, and I don't think we're changing it. So I think on that note, I'm going to end it. Hopefully, this basic kind of approach was better for a lot of folks, and we'll just try to keep shortening these videos up. So I want to thank everyone for tuning in, and I hope you got something out of it. Hope something helps you out this week or some week in the future. And I guess, yeah, thanks again. Have a great weekend and a great week ahead. And stay nimble out there. And I think you'll be just fine through this really wild card dominated week.